There are at least 5 bills the average American over the age of 65 is still paying every single year that they are not legally required to pay. 5 bills. And before I say one more word, I need to clear up the single biggest misunderstanding about this, because it's the exact reason most people click away and leave thousands of dollars sitting on the table. People assume a video like this is only for one kind of retiree. If they're comfortable, they figure it's for struggling, low-income folks, so they tune out. If they're living mostly on Social Security, they figure it's some advanced wealth trick, so they tune out. Both of those assumptions are wrong, and they're expensive. So let me be crystal clear right now. This list is for both of you. Whether your entire income is one Social Security check, or you've got a pension, savings, and a home that's tripled in value, there is real money on this list with your name on it. For some of these bills, the biggest win goes to the lower income retiree. For others, the biggest win goes to the comfortable middle-class retiree. And I'm going to tell you on every single one exactly which group it helps and how, so nobody watching can say, this isn't for me. Because the honest truth is, seniors at every income level are overpaying these bills. They're just overpaying in different ways. And here's why almost nobody tells you about these. It's brutally simple. Every person whose job it is to collect that money from you has a direct financial incentive to stay quiet. Your county doesn't call to tell you they'll freeze your property taxes. The Social Security office doesn't remind you that you can stop the withholding coming out of your check. And the tax preparer charging you $300 does not lead with the fact that you may legally qualify to have that exact return done for free. The single biggest one, a deduction worth up to $6,000 a year, is sitting right there, brand new. And most of the seniors who qualify will never claim a dollar of it. In the next 20 minutes, I'll walk you through all 5 bills, one at a time in plain English. Then I'll add 3 bonus moves at the end for the retiree who's built up some money. Because those last 3 can be worth a small fortune, and almost nobody talks about them. Here's the one idea that ties everything together, so write it down. Being legally exempt from a bill and actually not paying it are 2 completely different things. The law does not refund you automatically. Nobody mails you a check. You have to know the rule exists, and you have to claim it. That gap is the entire reason this video exists. Stay to the very end, because the last bonus move quietly costs people the most. And it's one of the easiest of all to avoid. Let's start with the biggest one. Bill number 1 is your federal income tax. And I need you to really hear this, because for millions of seniors, the correct amount of federal income tax you owe going forward is far lower than what you're paying. And for a great many of you, it's 0. Yet plenty of people are still paying it or still having it withheld out of pure habit and fear. Here's what changed. There's a tax law you've heard called the One Big Beautiful Bill, signed in July 2025. And buried inside it is something called the Senior Bonus Deduction. Starting with the 2025 tax year, the one you file in early 2026, every person who is 65 or older by the end of the year gets an extra deduction of up to $6,000. If you're married and both of you are 65 or older, that's $12,000. And here's the part that makes it so powerful. That's 6,000 stacks on top of everything you already get. It sits on top of your regular standard deduction. It sits on top of the extra standard deduction seniors have always gotten for being over 65, which is around $2,000 for a single filer in 2025. And critically, you do not have to itemize to claim it. That's rare. It's available whether you take the standard deduction or itemize. It's simply added on. Now, who does this help? Both groups, and here's exactly how. If you're a lower income senior living mostly on Social Security, stacking these deductions very likely pushes your federal income tax all the way to 0. It may mean you don't even need to file. And if you're a comfortable middle-class retiree, you're not left out, because the deduction is available in full to single seniors, with income up to $75,000 and married couples up to $150,000. It only begins to shrink above those numbers. And it doesn't fully disappear until you're over $175,000 single or $250,000 married. So the only people truly left out are the genuinely wealthy. Everyone from the retiree on a modest fixed income to the couple living on $90,000 a year gets real money here. And one more thing that makes this urgent, it's temporary. As the law stands, the senior bonus deduction exists only for 2025, 2026, 2027, and 2028. 4 years, unless Congress extends it. So this is a claim it now every single year while it exists situation. If you use tax software, it'll ask your age and apply it. If someone prepares your return, make sure they applied it. Look for it on the new Schedule 1A. That's bill number 1, and it's the single most valuable point in this entire video. Do not pay federal income tax you don't owe. That leads straight into bill number 2, because it's the other half of the same coin. Bill number 2 is the tax on your Social Security benefits. A lot of people believe Social Security is always taxed. A lot of others believe it's never taxed. Both are wrong. Here's the actual rule. Whether your Social Security gets taxed depends on something called your provisional income, which is basically your other income plus half of your Social Security. If you're single and that number comes in under $25,000, or married under $32,000, then 0% of your Social Security is taxable, none of it. As your income climbs, more of the benefit can be taxed, up to a maximum of 85% for higher income retirees, which means that even at the very top, 15% of your Social Security is always tax-free. So here's the win for each group. If you're a lower income senior, there's a very good chance the correct tax on your Social Security is 0, and that new senior deduction makes that even more likely. If you're a comfortable retiree, I'm not going to insult you by pretending it all vanishes, but the new deduction can still drop the taxable portion into a lower tier. And here's the mistake that hits everyone, rich or poor. When people file for Social Security, a great many of them fill out a form called the W-284V, telling the government to withhold federal tax from every monthly check, just to be safe. Then a big chunk comes back as a refund the next year, if they remember to file at all. Think about what that actually is. You're letting the government hold your money with no interest all year long on tax you may not even owe, or far more than you owe. The fix is simple. You look at your real numbers, or have someone look with you, and you file a new W-4V to right size or stop that withholding, so it matches what you'll actually owe and not $1 more. Whether you owe nothing or owe a little, the goal is the same. Pay what you owe on time, and not 1 cent early as a gift to the Treasury. That's bill number 2. Bill number 3 is the one that makes people genuinely angry once they find out. Your property tax. And I want to be precise here, because this is exactly where seniors at both ends get told they don't qualify when, very often, they do. There are really 3 kinds of senior property tax relief, and between them they cover almost everyone. The first kind is income-based, often called a circuit breaker, and it's aimed squarely at lower and fixed income seniors. If your income is modest, this can knock your property tax down dramatically. In some places, a low-income senior can have a huge share of their home's value exempted or the tax deferred entirely. The second kind is a flat senior exemption that knocks a chunk of value off the top, regardless of income. And the third kind, the one comfortable retirees always assume they're too well off for, is an age-based freeze with no income test at all. Let me give you the clearest example. In Texas, once you turn 65, you get a tax ceiling that freezes your school property taxes at the level you paid the year you turned 65. Your home value can double, but your frozen tax doesn't go up, and there is no income limit on that freeze. It doesn't matter how comfortable you are. You qualify because of your age, period. Texas is far from the only state with a freeze like that. So look at how that covers both groups. The lower income senior gets the income-based relief that can wipe out most of the bill. The comfortable senior, who's shut out of the income-based program, still gets the age-based exemption or freeze that the wealthier homeowner assumed wasn't for them. Here's the catch that costs everyone. None of these are automatic. Your county does not look at your birthday, see that you turned 65, and apply the discount. You have to file. And almost every one of these programs has a hard deadline, often early in the year. Miss it, and you pay the full bill that year and wait until next year to try again. Why won't your county chase you down to claim it? Because every $1 of relief you claim is $1 of revenue they lose. So you make one phone call. Call your county assessor, or search your county assessor plus senior exemption and freeze, and ask 2 questions. 1. What relief do you have for homeowners over 65? 2. Which programs are based on age with no income limit? That one call has been worth hundreds, often thousands of dollars a year to people I've seen at every income level. That's bill number 3. Bill number 4 is your Medicare premiums, and there are 2 completely separate overpayments hiding here. Conveniently, one helps everybody, and the other helps the higher income retiree. The first is simple, and it's for everyone. Medicare Part A, the part that covers hospital stays, is supposed to cost you 0 in premiums if you or your spouse worked and paid into the system for at least 10 years, which is 40 quarters. The vast majority of Americans have done exactly that. Yet some people pay a Part A premium they never needed to because of confusion about a work record. That's worth a hard second look, no matter what you earn. The second overpayment is aimed right at the comfortable retiree, and it has a name that sounds like a person. IRMA, the income-related monthly adjustment amount. It's a surcharge that piles on top of your Part B and Part D premiums once your income crosses certain levels. By definition, this only hits people with a solid income. And here's the trap inside the trap. The income they use is not this year's income, it's your tax return from 2 years ago. So your 2026 Medicare premium is based on your 2025 income. Picture this. You're 64, 65, still working, earning a good salary. Then you retire and your income falls off a cliff. But 2 years later, Medicare looks back at that old high income return and hits you with a surcharge based on money you're no longer earning. People just pay it because it shows up as a quiet deduction from their Social Security, and they assume it must be correct. It is not necessarily correct. And there's a form to fix it, the SSA 44. When you've had what the government calls a life-changing event, and retirement is specifically on that list, along with the death of a spouse, divorce, or a drop in income, you file that form. You show them your income has fallen, and they recalculate your premium based on your real current situation. I've seen that single form put thousands of dollars a year back in a retiree's pocket. Almost nobody files it because almost nobody knows it exists. So, Part A being free is the win for everyone, and the IRMA appeal is the win for the higher earner. That's bill number 4. Bill number 5 is going to feel almost personal because it's the fee you pay to deal with all the others. Bill number 5 is your tax preparation fee. Every year, millions of seniors walk into a storefront tax office or a big-name chain and pay somewhere between $200 and $500 to have a fairly simple retirement tax return prepared. And many of those people legally qualify to have that exact same return prepared for free by people the IRS itself has trained and certified. There's a free program built specifically for seniors called TCE, Tax Counseling for the Elderly. It's an IRS program for people 60 and older, and it specializes in exactly the questions retirees have. Pensions, Social Security, retirement account withdrawals. The largest provider of it is AARP TaxAid, which runs thousands of sites across the country. And you do not have to be an AARP member to use it. Its focus is older adults of modest to moderate means, and that phrase matters because it's not just the lowest incomes. It covers the broad middle too. On top of that, the IRS now has its own free online filing options for people comfortable doing it themselves, including IRS Direct File and the Free File program. Now, here's the honest line, and it applies to everyone. If your situation is genuinely complicated, a business sale, rental properties, a complex estate, then yes, pay a real professional. It's worth every penny, and I tell you to do exactly that. But if your return is straightforward, 2 Social Security checks, a pension, maybe a few investment statements, you should not assume you have to hand a chain $300 for 45 minutes of data entry. If your return is simple, the law has already built you a free qualified option. And your age makes you eligible, whether you're scraping by or doing just fine. Using it isn't cheap. It's smart. That's bill number 5, and it's one of the easiest to act on this year. Now I promised 3 bonus moves, and I want to be straight about who these are for. The 5 bills I just covered reach across every income level. These last 3 are specifically for the retiree who's built up some money, a home that's appreciated, an investment account, a healthy IRA. Heck, if that's not you, don't feel left out. The first 5 already had you covered. But if you've built up something, these 3 can be worth more than everything else combined. And the low-income focused videos never mention them because their audience can't use them. You can. Bonus move number 1, the tax on selling your home. Here's the fear that lives in people's heads. You bought your house decades ago for $60,000. It's now worth $400,000, and you're terrified that if you sell, the government will tax you on that enormous gain. So you don't downsize. You stay in a house that's too big and too expensive because you're afraid of a tax bill. And in most cases, that tax bill does not exist. There's a rule called the home sale exclusion. If you've lived in your home as your main home for at least 2 of the last 5 years, you can exclude up to $250,000 of gain from tax if you're single, and up to $500,000 if you're married filing jointly. Gain, not sale price. The gain is what you sold it for, minus what you paid, minus the improvements you put in. So that couple whose home went from $60,000 to $400,000 has a gain of around $340,000. And as a married couple, they can exclude $500,000. Their federal tax on that sale is 0. They were sitting in a house they no longer wanted, scared of a tax that was never going to hit them. Bonus move number 2 is for the retiree with money in regular investment accounts, stocks or funds that have gone up in value. And it's one of the best kept secrets in the tax code. It's called the 0% capital gains bracket. When your taxable income is low enough, the federal tax rate on your long-term capital gains is not 15% and not 20%. It's 0 for 2025. A married couple can have taxable income up to about $96,700 and still pay 0% on their long-term gains. For 2026, that rises to about $98,900. For a single person, that line is roughly $48,000 to $49,000. And remember, that's taxable income, your income after your deductions come out. So a couple bringing in well over $100,000 total can still drop into the 0% zone after the standard deduction and the senior bonus, and sell appreciated investments without paying a dime of federal tax on the gain. Retirees are in the perfect spot to use this, because in the years after you stop working and before large required withdrawals kick in, your income is often at its lowest. That's the window. A smart retiree harvests gains in those low-income years on purpose, completely tax-free, instead of letting it all pile up and get taxed later. One honest caution: realizing a gain can raise your provisional income, which can pull more of your Social Security into being taxable, so the smart move is to work the actual numbers, or have someone work them with you before you sell. Bonus, move number 3 is for anyone 70, 1 to 2, or older who gives to charity, even a little, and has money in a traditional IRA. It's called a qualified charitable distribution, or QCD. Once you're 70, 1 to 2, you can have money sent directly from your IRA to a charity, up to $108,000 in 2025, rising to $111,000 in 2026. And that money is completely excluded from your taxable income. Now you might say, I already deduct my donations. Here's the thing. Most retirees today take the standard deduction, which means their giving earns them no tax benefit at all, because they're not itemizing. The QCD fixes that. The money never shows up as income in the first place, which is even better than a deduction, because it lowers the income number that everything else is based on. Your Social Security taxation, your IRMA surcharge, all of it. And once you reach the age where you're forced to take required minimum distributions, a QCD counts toward that requirement. So instead of being forced to pull money out, pay tax on it, and then donate what's left, you send it straight to the charity, satisfy your required withdrawal, and pay no tax on any of it. If you give to your church or any cause and you have an IRA, this is one of the most powerful tools you have. So let me tie all of this together with the one idea that matters more than any single rule I just gave you. In every one of these cases, the law already says you're exempt, or you qualify, or you don't owe. The senior deduction is in the law. The Social Security rules are in the law. The property tax relief is on the books in your own county for the modest income senior and the comfortable one alike. The Medicare appeal form is sitting on the government's own website. The free tax help is funded and waiting. The home sale exclusion, the 0% capital gains bracket, the charitable distribution, every one of them is real. But not a single one is automatic. The government does not refund you for a rule you didn't claim. Nobody mails you a check for the deduction you forgot to take. The entire system is built so the money stays where it is, unless you stand up and claim it. Being legally exempt is worthless until you actually act on it, and it does not matter whether your income is small or comfortable. There is a version of this list that's overcharging you right now. The people who collect these bills are counting on exactly one thing, and it's not that you're dishonest, and it's not that you're careless. They're counting on the fact that you assume the relief is for someone else. The struggling senior assumes the good stuff is for people with money. The comfortable senior assumes the relief is only for people who are struggling. And so both of them keep paying. That's the whole game. Knowing the rule, and knowing it applies to you no matter where you sit, is the entire thing. So do one thing for me. Send this video to one person in your life who's over 65 or getting close, a parent, a neighbor, a friend from church. It doesn't matter if they're getting by on a single check or sitting on a paid-off house and a nest egg, because the odds are very good they're paying at least one of these bills right now for no reason at all. One share from you could be worth more to them than any gift you'll ever give. And one last reminder before you go. Tax rules have income limits, deadlines, and details that depend on your exact situation and your state. Nothing here is personalized advice, so before you file this year, take this list to a qualified preparer, a free TCE or AARP tax aid site, or check the figures directly on irs.gov. Go down it one by one, and make sure you're not leaving a single dollar on the table.